Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining me this Friday afternoon, we have Marex, Senior Index Specialist with Nasdaq Index Research, for a look at technicals that we need to be aware of in the Nasdaq-100. Mark, it's great to see you as always. We love when we get to do these reviews. Let's start with your first chart, and we can take a look at the relative strength indicator. I know it's something that you look at.
Yeah, thanks, Jill. Great to be back talking about Nasdaq-100 technicals again. And on this first chart, you can see the purple line. That's the history for this thing called the 14-day RSI, the relative strength indicator, measure of kind of technical momentum in the market, whether things are getting a little bit too overheated. Anything above a 70 on that purple line on the left-hand axis, that's a pretty bullish sentiment. Anything over 80 is usually considered to be really overheated. So what I circled here is really the last time that we touched 80, which was just about a year ago. And we had a nice little correction there in September of last year. This year, and really since then, you can see we've barely been above 70 at all. At the same time, we've been making new highs. We're over 15,500 now on the Nasdaq-100. And in very kind of, I would say, comfortable RSI territory. You can't have an RSI too low when you're setting all-time highs, but we're kind of comfortably below 70 in the last couple of days here. Had a bit of a pullback today. And meanwhile, for one of the first times all year, we've been trailing the S&P 500. This index is actually outperforming finally now on a year-to-date basis as we get some of that reversion to the reversion trade, which we had earlier, kind of pro-cyclical, pro-inflation, pro-reopening, with Delta coming back, some of those good old-fashioned kind of safe haven tech names creating some strength in a Nasdaq-100 and a steady and slow grind up.
And if we take a look at your next couple of charts here, this is where you're looking at the shorter and longer term moving averages to discern some trends.
Yeah, sure. So first up, we've got the 20-day and the 50-day moving averages highlighted here. What I've shown with you in terms of the circles are just the last several pullbacks we had when we dropped below, meaningfully below the 50-day, as well as the 20-day. You can see this year we have kind of very briefly either touched the 20-day or dropped slightly below it and then immediately rebounded. Haven't been in danger really of crossing under that 50-day moving average and having what you would consider to be maybe higher odds of a longer term correction. So, we are maybe seeing a bit of correcting action happening later this week, but we're still kind of nowhere near blowing through some of that short-term support that you see with both of these indicators, the 20-day and the 50-day. On the next slide, we've got longer-term indicators that we look at as well in terms of the 100-day and the 200-day moving averages. What I've circled here, similar. The last time we breached the 100-day, that was earlier this year in kind of May. We briefly breached it earlier this year again, kind of in early March. We briefly breached it. We were never in danger of breaching 200-day. We're very, very high above the 100-day right now. So it would take quite a bit of a downdraft to get us in danger of having what you would consider to be like something like a sustained correction or a sustained bear market.
Right. And Mark, can you also take a look at options activity as well?
Yeah, this last one is a cool little, duo of slides and indicators. On the left-hand side, that's telling you the overall U.S. equity market options ratio of puts to calls. So usually when you have a ratio of more than 0.7 puts outstanding for every call option that is outstanding in the market, that's considered to be pretty bearish territory. You can see here with this trend line, we've been in a pretty, consistent downtrend up until maybe a couple weeks ago. We've started to kind of jump above that trend line. People starting to get a little bit more defensive because, again, it's been a pretty powerful, pretty long rally since the lows last year. So something to keep an eye on as we kind of approach 0.6. If we get closer to 0.7, I would say that's when sentiment's really starting to turn in the market generally. And then on the right-hand side is the Vol Q index, which looks at options activity in the Nasdaq-100 to estimate the volatility of that index. What I've outlined here is that kind of magic line of 20. Anything above that is considered kind of more volatile. You can see we shot right up above that and stayed above it for a good chunk of last year. This year's been the opposite story. We've been mostly below it. And, maybe starting to inch back up to that 20 line, similar to that options ratio. We'll definitely pay attention to this as we get closer to those kind of magic lines, those demarcation indicators to see, is sentiment really changing? But right now, it's kind of just toes getting into the water. I think people getting a little bit more defensive, which is actually helping the index in terms of its performance because it has been this kind of safe haven throughout the pandemic.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.